Welcome to the deep dive. Most investment talk is, it's all about timing the market, finding the next big thing.
Riding that momentum.
Exactly. But today, we are throwing all of that out the window, all the emotion. We're diving into a very specific mathematical investment algorithm, and it's designed for just one thing: to eliminate human feeling from investing and, get this, outperform the market, even if you make the huge mistake of starting right before a crisis.
And that's really the crucial context here. If you're someone looking to get your head around complex strategies quickly, this is, it's basically a masterclass in discipline.
Right.
We're going to dissect a routine that sort of blends dollar cost averaging, contrarian thinking, and rebalancing all into one single automated system. It really just turns investing into a business routine.
And the sources we looked at, they all say the same thing, that until you see the actual math laid out, the leverage it creates just doesn't quite click.
It's hard to grasp.
So that's our mission today. We are going to give you that practical step-by-step breakdown using the clearest example we could find, the one the creators themselves used: a clean and transparent test portfolio.
Let's lay out the rules they set, because this wasn't just some theory. This was real money following very, very rigid rules.
Okay, let's unpack this. Walk us through the setup. What was the investment goal? The time horizon?
The parameters were intentionally simple, but absolutely rigid. The total investment was set at $3,000.
Okay, 3,000.
Spread out over exactly 20 months.
So right away, that forces you into a fixed routine. That's what, $150 a month?
$150 every single month. No exceptions, no excuses. It didn't matter what the market was doing.
And they didn't just put it all in one place, right? I mean, they diversified to manage the risk.
Exactly. They chose a basket of 20 different assets from their prior research. So that very first 150, that first budget, it was split evenly.
So $7.50 into each of the 20 assets to get things started.
Yep, that's what kicked off the clock.
Now, here's the detail that, for me, changes everything about how this works: the timing. This portfolio went live on December 17th, 2021.
Oof.
Right? If you remember that date, that was the peak. I mean, literally weeks before the whole market started to turn south. This thing was born in the middle of a crisis.
It's probably the worst possible time you could choose to start a 20-month plan, which ironically makes it the perfect test case for the strategy.
It really does.
But the discipline goes even deeper. They didn't just invest on, the first of the month like most people do.
So how did they manage the timing then?
The timing was tied precisely to the investment cycle. So if that first purchase was on December 17th...
the next one had to be January 17th.
Exactly. January 17th, then February 17th, and so on. It completely removes the temptation to, wait a few days or hold off till payday. It keeps the whole process like a machine.
That rigidity leads us right to the engine room then, the actual mechanics of the algorithm. So the clock hits the 17th of the month. How does the system decide where that $150 goes?
So this is where the contrarian rotation comes in, and it's brutally efficient. So every month, until that last cent of the $3,000 was spent, which was July 2023, by the way.
Right.
The algorithm performed this routine. Step 1, measure all 20 assets. Step 2, find the 10 most lagging assets, the ones that did the worst over the last month.
The 10 losers.
The 10 losers, precisely. And step 3, that entire $150 budget gets distributed only among those 10.
So $15 each?
$15 into each of the worst performers.
Yeah.
You are systematically starving your winners and just feeding your losers.
I have to stop you there because that sounds, to the average person, just terrifying. We're all taught to, buy what's working, let your winners run.
Right.
This is intentionally doubling down on what's weakest. Isn't that just buying garbage, catching falling knives?
That's the human bias talking. But the algorithm doesn't have that. It relies purely on math and the principle of mean reversion.
Okay.
It just assumes that with a big enough basket, those 20 assets, the underperformers are statistically likely to eventually come back toward the average performance of the group. That 150 isn't speculation. It's spent optimizing your average price for when that recovery happens.
So this is that blend of concepts you mentioned. DCA for the fixed monthly amount, contrarian rotation because we're targeting the weakness. But what about rebalancing?
Well, the rotation is the rebalancing in a way, but it's selective. Normally you'd sell some winners to buy losers.
Right, get back to your target weights.
Yeah, but this algorithm uses that fresh injection of $150 to do it without ever selling anything. It systematically adds weight to the positions that have dropped, which lowers their average cost and brings them back into, let's call it risk parity, much faster than they would on their own.
That makes a lot of sense. You're using new cash to re-optimize on the fly. Let's get to the really important part, though, the math. What does all this aggressive buying into weakness actually do to the average price of an asset that's struggling? This is the real aha moment.
And the math is, well, it's actually stunningly simple. Over the full 20 months, the total you invest in any single asset is going to be $150.
Right, 3,000 divided by 20.
So that 150, that's your break-even point for the entire investment period, theoretically.
Okay, standard stuff. But let's follow one of these assets. Let's call it asset X.
Sure. So let's say asset X starts at a price of $100. The algorithm buys $750 worth. Then the market just tanks.
Yep.
Month 2, asset X is down to $50. It's obviously one of the 10 worst performers, so it gets a $15 injection. Month 3, it falls even more to $25. Still a huge loser, so it gets another $15.
Now, a normal DCA investor, they might just buy $750 every month no matter what. Their average price would fall, but slowly. Here, asset X is getting double the money when it's at its worst.
Exactly. The system forces you to buy heavily when prices are at their lowest. That $15 buy at $25 is buying way more units than the initial $750 at $100.
Of course.
And these bigger, concentrated buys just radically pull down the overall average purchase cost for asset X. I mean, that one $15 investment might drop your average cost from, say, $70 down to $60.
So what happens if asset X just gets a little bounce? It doesn't even have to recover fully. It just goes from 25 up to, say, 30.
Yeah.
What happens to those recent $15 buys?
And that's the leverage point. That's the whole game. Those recent $15 entries, the ones you bought at rock bottom prices, they are instantly in profit.
Wow.
They might be up 10, 20% on just a tiny price move. What you're doing is building a chain of tiny micro profits inside the losing position.
You're essentially reloading the position with incredibly cheap ammunition.
That is the perfect analogy. You're building these highly leveraged little positions inside a struggling asset. By buying into the negative momentum, the algorithm sets up what the source material called momentum-adjusted recovery.
Okay, what does that mean?
It means that the second momentum turns even a little bit positive. The recovery for that asset is super steep and profitable because you've optimized your cost basis so aggressively. The worse the time is for an asset.
The better the time is to buy.
And the faster it breaks even and makes a profit when things finally turn around.
This all sounds so clinical, so robotic. It requires an absolute commitment. Which brings us to discipline. If the entire point is to buy a weakness, what's the one critical rule that the sources point out, the one that we humans almost always break?
The rule is simple, and it's everything. Do not stop the strategy when your assets are in the minus. That period of decline is the most valuable part of the whole algorithm. It's the golden part, not a sign that it's failing.
Why? I mean, emotionally, that's the hardest thing to do. What's the mathematical reason?
If you panic and stop investing when asset X is down 70%, your average price is now frozen at that high level.
Stuck.
Exactly. Stuck. For that asset to just break even, it now needs a massive, painful recovery, maybe 300 or 400%. But if you keep the routine going, keep hammering down that average price,
Needs a much smaller recovery to get back to profit.
maybe just 50 or 75%. Investing during the crisis is what creates the leverage for the returns later on. Stopping the routine kills that leverage.
They just flips conventional wisdom on its head. We're always told to preserve capital when things are bad. This forces you to deploy it.
It forces you to treat your investment not like a bet, but like a necessary business cost for future growth.
So let's talk about that growth. Let's get to the performance. This thing started in December 2021, invested right through that whole downturn until July 2023. What did the source material show for the actual performance?
The results, they really speak for themselves. By the time that final $3,000 was invested in July 2023, the portfolio's value was already at $3,900.
So a 30% profit while it was still in the buying phase, navigating a bear market.
Exactly. It was profitable before the contributions even stopped.
And then what happened? When the funding stopped and the portfolio was just left to live its own life?
That's when the effect really took off. As of the source date, the strategy was up 60% in the last year alone. 51% year to date.
Wow.
By using that deep negative period in 2022 to just hammer down its cost basis,
Right.
this systematic approach ended up crushing the major benchmarks like the S&P 500 and the NASDAQ over that same time frame.
That is remarkable, especially given where it started. But let's play devil's advocate here. Risk. What about risk?
Hmm.
You mentioned they picked 20 assets. What if one of them just dies, goes to zero? The algorithm would just keep throwing $15 at it all the way down.
That's a crucial question. And the mitigation for that is baked into the setup, the risk parity allocation of having 20 assets.
So diversification.
Right. The strategy just assumes that, okay, one or two might fail completely, but the gains you make from the optimized entry points on the other 18 that recover will more than make up for that loss. The overall basket just needs to not fail catastrophically.
Meaning the whole strategy hinges on the idea that the broad market, like the S&P 500, isn't going to collapse and just stay there forever.
Correct. The risk is pretty low, provided the market doesn't fall below its starting price for, years and years.
Yeah.
The source gave a hypothetical.
Mhm.
If the S&P 500 fell to 2,000 and stayed there, yeah, the whole thing would sink.
Unlikely, but possible.
But assuming the market's general long-term trend is up, this algorithm is basically designed to capture that growth with maximum efficiency by leveraging all the low points along the way.
It really is a synthesis then. You've got dollar cost averaging, but it's selective. You've got rebalancing, but with new money. And you have this, momentum adjusted recovery, by forcing yourself to buy when momentum is terrible.
It minimizes risk through diversification and maximizes return through just ruthless mathematical discipline. It's the closest thing to taking what all successful long-term investors preach: buy low, stay diversified, be patient, and turning it into a system.
A system that removes the biggest problem.
Human fear and greed. It just treats investing like a routine business process.
That really is the final takeaway, isn't it? This formula works because it guarantees you buy low every single month, whether you feel like a genius for doing it or you feel like an absolute fool. It's just a structure built on math, not emotion.
And since this whole thing is really about removing emotion, about maximizing the small bounces and forcing investment into the most neglected areas, consider this thought for a second. If you were to apply this kind of disciplined routine to other parts of your life, like your career or learning a new skill, where would you be putting your investment of time and effort? Into the areas that are your most lagging? And why might that kind of contrarian logic be the key to really rapid leverage personal growth? Think about that kind of leverage.